The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Manufacturing and logistics demand in Indonesia and Vietnam is poised to grow by up to 20% over the next 3 years, driven by multinational companies' strategic shifts towards building resilient regional supply chains rather than merely responding to short-term tariff changes. Now, that's according to Knight Frank's Horizon report, From Whiplash to Resilience, Corporate Real Estate in the New World Order. Now, this trend reflects a broader move under the China+N strategy, where firms from China, Japan, and South Korea are investing in Southeast Asia to capitalize on cost advantages and diversify their supply chains through access to modern, purpose-built industrial facilities. So how will these dynamics shape the industrial real estate landscape in the region? What factors will most influence companies' decisions to relocate or expand operations in Indonesia and Vietnam? Well, to find out more, joining me now is Christine Lee, who's the head of research of Asia Pacific at Knight Frank. Christine, welcome back to the show.
Thanks for having me.
Thank you so much for joining us. Christine, Trump 2.0 seems to be signaling a fundamental reordering of the global trade architecture, both in breadth and, intensity. How would you, describe the most fundamental shift in the corporate real estate landscape under the Trump 2.0 tariff regime?
Yeah, that's a big question, because the most fundamental shift that we are seeing is the trade volatility has become structural, so they are no longer cyclical. And before Trump, I think a lot of companies are more or less focused on cost efficiency and also access to global markets. So the real estate strategy now includes a trade policy playbook, and these tariffs create a host of downstream consequences for businesses. And these are the very tenants that actually occupy our offices, our warehouses, logistics spaces. So the most important question now is how to react to preserve that business continuity and also to respond to this prolonged uncertainty. So while deciding where to locate their operational base, businesses usually have to build in that tariff exposure and also geopolitical risk into their corporate real estate strategies. And they are now considering terms like tariff-sensitive lease structures and also tariff break clauses, which are designed to manage the impact of tariffs. So such structures actually allow for some adjustments in terms of the lease payment or even obligations based on changes in the tariff rates and also import duties. So no doubt it will impact pricing, but location-wise, we will also see some premium or even discount associated with these geopolitical risks.
Okay, very interesting. Well, then how are companies rethinking location strategies in light of heightened geopolitical and trade volatility?
Yeah, the key word here is flexibility and agility. So it is really something that companies are looking at now. I mean, for office spaces, this basically means favoring very short-term leases, more flexible leases, or even customized-based solutions such as your co-working spaces in terms of very long-term, 5 to 7 years fixed tenancies. So offices leases, for instance, in Indonesia have actually evolved from a 5-year norm to now under 3 years. So this is mainly driven by the US-China trade war and also the pandemic and alongside hybrid working models. And some break clauses and rent-free periods are also a lot more common now, as landlords also compete for flexible lease terms for the tenants. So I think, things will just get more unpredictable, and companies are also getting smarter on how they want to set up their logistics and also manufacturing hubs.
Well, on that note, Christine, how has the demand for office and industrial space evolved across major Asia-Pacific markets in response to such trade realignments?
Yeah, I think companies have been snapping up logistics spaces, also mainly to stockpile their inventory and also to protect themselves from the supply chain hiccups. In India alone, we saw that warehouse demand actually shot up by 44% a year between 2017 and 2020. So this is largely because firms wanted to hold more goods closer to their customers. And we also saw a big jump in the Chinese mainland manufacturing investing in Malaysia. Foreign direct investments rose more than fivefold over the last 1 year or so. So that gives a real boost to the leasing activities there.
Okay. Well, according to Knight Frank's latest report here, the China+N strategy has, become a standard operating model rather than just a response to tariffs. So just for some context here, what exactly is the China+N strategy and what are the long-term strategic implications of this model for CRE portfolio planning?
Yeah, we used to call it the China+1 strategy, but now it's sort of spreading out the manufacturing base to as many geographies as possible. So companies aren't putting all their eggs in the China basket. So instead, they can start building and shifting parts of their supply chains to another country. And this really picked up steam during the pandemic when the lockdowns and also the health rules throw the global supply chains into chaos. And now the idea has really evolved into the broader China+N approach. Like what Siemens CEO said, we are tariff-free because we produce where we sell. So with these uneven tariffs and trade tensions, especially between U.S. and its partners, having corporations in more than one location is not just nice to have, but it's really a strategic must.
Well, then which APEC markets do you see as the most resilient or promising in this new era of fragmented global trade?
Yeah, in the past, of course, Southeast Asia, especially Vietnam, was the big winner during the first wave of the China+1 shift. So companies really set up shop in Vietnam and it saw a lot of action. But I think this round, India is actually shaping up to be the biggest beneficiary. We have heard, Foxconn, one of Apple's key suppliers, is teaming up with India's HCL group to build a US $433 million semiconductor plant, which is expected to be operational by 2027. And personally, I also feel that Malaysia is going to be maybe just really shaping up to be a more reliable partner in the region as well. So we have already heard quite a lot of, actions in Malaysia, things like your Johor Singapore Special Economic Zone. I mean, these are quite a lot of strong signals for Malaysia's growing role in this cross-border manufacturing and logistics. So I think it's in a very good spot to benefit from the ongoing shift in the global supply chain.
Okay, well, let's dive into some of these markets as well a little bit further. Indonesia and India, they maintain strong growth potential according to your report. You mentioned about India earlier in our conversation, but what are the key factors driving, Indonesia and India's projected growth in real estate demand?
Yeah, if you look at these two countries, they definitely stand out in our report as markets with strong long-term potential for real estate because a lot of that comes down to the fundamentals. So first off, you see both countries have very massive population. India has over 1.4 billion and Indonesia has also more than 270 million. So that means a very large domestic base, which is very attractive for manufacturers and also retailers because it means a relatively young population and also a growing workforce as well as rising urbanization. So on the industrial front, I think both markets are also benefiting from that push to diversify supply chains away from China. So we are seeing strong interest from multinational companies, especially in sectors like your electronics, your EV, and also pharma. They are investing in a lot of logistics warehouses and purpose-built manufacturing facilities to serve both the export as well as the local markets.
Okay, well, Vietnam looks like it's both the top beneficiary of China+N model and highly exposed to U.S. tariffs here. How is this duality affecting investor sentiment and leasing decisions over there?
Yeah, even though Vietnam is really feeling the heat from the higher tariffs, especially being so export-driven, the bigger trend of supply chain diversification is still pulling in strong investments. So just last year, we saw that Chinese manufacturers actually pumped in over $6 billion into Vietnam. Indonesia wasn't far behind, basically landed about $3 billion in newly announced projects. So we are still seeing logistic demands in Vietnam, which jumped by about 17% on an annual basis between 2020 and 2024. So it's a clear shift that production is going away and also into Southeast Asia. So I would think that Vietnam continues to be a key piece. It really depends on how the negotiations between Vietnam and U.S. taking shape after the 90-day pause. But on the ground, we have already seen some action. For example, Japan's Mako Electronics They are investing $340 million into a new plant in Vietnam, making ultra-small and energy-efficient circuit boards for iPhones. So interestingly, instead of going straight into China, these parts will actually be sent to India for final assembly since the tariffs there are lower. So this kind of move says a lot about how companies are thinking several steps ahead when it comes to supply chain strategy.
Right. Well, meanwhile, for China here, Christine, the Chinese mainland may see temporary relief from the tariff reduction, but structural challenges, of course, persist here. So what are the structural challenges investors should take note of?
I think for China, the story is a bit of a demand-supply imbalance. So office demand in top cities in China has really hit a wall. There are just too much space and not enough takers, with vacancy rates still sitting above 20% for now. And rents have been sliding over the last 3 years. It's good news for, occupiers, but not so good news for landlords and overall sentiment. I think a big part of this is the slower economy, and it's not just the domestic policy. Geopolitical tensions also played a key role. For instance, we also noticed some U.S. law firms shrunk their presence as trade war disrupted their business flow. So it's really just not the office sector, but all the other sectors are also feeling the heat and the squeeze.
All right. Well, overall here, how should the CRE strategy evolve in this volatile landscape?
Yeah, I think for landlords, they have to be very accommodating in negotiations to sort of preserve or raise their occupancy rates, because there are ample options for occupiers out there to secure the best spaces at good rates, which has resulted in this flight to quality moves. But given the current situation, I think the corporate real estate strategy in China or other parts of the world should remain focused on cost rationalization. We hear a lot of times, companies want to right-size their presence because there's AI, there's technology, there's also a lot of other options. For example, your outsourcing moves where you don't have to have all your workforce in one location. So I think in terms of the government's incentives, it can also be a bit more accommodative, focused on stimulating consumption or stimulating some of the programs that helps some of these SMEs or MNCs to do business easier.
Some great insights from you there. Thank you so much, Christine, for joining me today.
Thank you so much for having me.
Thank you. That was Christine Lee, who is the head of research of Asia Pacific at Knight Frank. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app.